Hi, I'm Joe Lopresti, and this is our Market and Economic Insight for Friday, January 14th. Happy New Year to you. I hope you had an enjoyable holiday season and that 2022 is getting off on a good start for you. Well, we're 2 full weeks into the year, and speaking of good starts, that has not happened for the stock market. Struggling a bit entering into 2022. While the first couple of days were solid and the market's S&P hit a new high, since that time there's been a fall off in equity prices. In our last update, we highlighted some of the higher growth areas of the market that were really struggling and were down 20, 30, even approaching 40% from their 2021 highs. Well, that's accelerated coming into 2022. And we're going to focus on highlighting that a little bit further in this update. So let's jump in to look at our proactive asset allocation dashboard. You see there's really no changes to any of the directional signals. The major trends continue to be positive. Although our last signal, which is now going back more than 10 months, was the tactical sell signal on March 1st. It's been a very long time without a signal in our model. That perhaps is the longest. I haven't looked at the history to say for sure, but in my immediate recollection, 10 months in between signals is a long time. We've talked a lot about how the Fed being involved in the market, the government involvement in the market, has held trends in place longer than typically occur in normal market cycles. And while the market has attempted to correct a couple of times, it's always come up short from going into really a good, solid correction that wrings some risk out of the market and provides a good entry point for new capital to invest. Perhaps the correction we're getting now, the early 2022 weakness, will provide us that opportunity. Of course, we'll have to be patient and wait to see if that develops. Looking at our core indicators, again, no status changes. We've pointed out how the universe trend indicator has been negative for a few months now. That continues to be the case. The long-term momentum indicator has been neutral for 4 months now. So with the year end, the month end of December, it's 4 consecutive months with a neutral status. We're really going to step in and take a close look at the long-term momentum indicator in a minute. And our cash comparison charts, we haven't looked at them much recently because they just haven't changed very much, but they continue to be positive. Let's step in and take a look at our long-term momentum indicator. This is for the global stock index, a very broad universe of stocks, about 4,200 or so around the world. And you can see the latest reading, neutral once again. This particular part of the momentum has been sliding since the end of August or September. So it's been fairly long time with a neutral reading. You could see this is a 10-year look back, and there have been other times similar when there's been a long stretch of neutral status, but not very often. You could also see a lot more choppy action in here. These are end-of-month prints for the global stock index. So a lot more choppiness and volatility from month to month has set in, certainly compared to that long stretch of just mostly upward action, a little bit of a pullback there in the summer, fall of 2020. But besides that, it's been mostly up and away since the COVID low. Now, one thing we've pointed out in the past is that this particular part of the momentum indicator has gotten to a very high level. What I'd like to do now is compare this particular time in the indicator when it's at a very high level compared to other times when it was at a similar level. So now as we expand the chart to show the full history, which goes back to 1995, as you could see here, you could see the recent high was actually the highest reading for the momentum indicator in that, say, 27-year period or so. Other times when it got close, you could see here on the chart. Let's take a look at those in a little bit more detail. The first time that it hit a very high level and then started to wane from a momentum standpoint was in 2000. And we could see in hindsight that ended up being a very important high in the market, a significant peak. And stocks went through a very long and steep bear market. It was a good 2+ year drop with over a 50% drop in the S&P 500. This particular time that the momentum indicator hit a high in 2004, as you could see, it wasn't near the end of a market cycle. There was a lot more time and room left for stocks to run. And very similar here in 2010, when the market, or I should say the momentum indicator, hit a very high. It was up towards the higher end of its range, and a bit of a stall, as you could see in both of these cases, but stocks continued to run for quite some time. So what's the difference between a 2000 period and a 04 or 2010 period? Because we could see where we're at today is a very similar position. Very high number from a momentum standpoint, and now starting to roll over and wane a bit. Well, the first thing we could point out, in 2000, we could see stocks were going through a multi-year advance, and we're at an all-time high. So the market itself was positioned very high. Therefore, when the momentum rolled over, it developed into a cyclical change from a structural bull market to a structural bear market. That was much different in 04 as we were coming off of that bear market. So stocks were not trading at all-time highs, had not even surpassed the previous high. And something very similar happened here in 2010 after that second structural bear market in 07, 08. Coming off of the bottom, stocks had a very strong surge upward, which pushed that momentum very high. However, the market itself had not gotten back to a high and had not been advancing for multi-years as it was in 2000. So where does that put us today? Well, from that perspective, I'd have to say we're closer to the 2000 example than the 04 or 2010 period, right? We're at a new all-time high. Stocks had been climbing for a long time. Certainly we had that sharp drop during COVID, but that didn't last very long, and wasn't based on natural economic and monetary cycles. So, we're not at a point where we'd say we're getting a cyclical change, right? Our market model has not turned negative. That could be coming, but we're not there yet, and we don't want to anticipate that happening. We do want to be aware, though, that this setup is similar to other times. One of those times, it turned into a major change in the market cycle from an up to a down, and that's what we want to avoid. Our market model is designed to help us identify potential bear markets and, more importantly, the change from a bull cycle to a market topping process and then a bear cycle. Our investment strategy is very much focused on active risk management and wealth preservation. That's a core tenet of our discipline. So we have those things in place, and we'll be continuing to monitor in case this develops into a major change in the market cycle like it did there in 2000. I think from a different perspective, when we look at 2000 versus 04 or 2010, one other area that we want to focus on is market valuation. Today stocks are valued very high. This is the Shiller or KPE ratio. We could see current reading 39.6. That's the second highest level ever, only surpassed by that 2000 peak. When we look at 2004, we could see the valuation of the market was significantly lower. When we look at 2010, we could see it was even lower yet. So today, we have a higher valued stock market, similar to what we had in 2000. Therefore, we want to be aware that when stocks are valued very high, there's room underneath them for a larger drop and a potential change from a bull cycle to a bear cycle. Another way to look at market valuation is to take the U.S. total market capitalization of all the stocks and what the percentage that is of the overall size of the economy. And here, once again, when we look at the current position, very high. It's off of its all-time high, which came in the early to middle part of last year, but nonetheless, barely off of the all-time high. When stocks are 193% of the size of the economy, it's almost 2 times the size of the economy. Well, the last peak that happened here in 2000, you could see stocks were closer to 150% of the overall economy. And if we look at 04 or 2010, stocks were under 100% of the total economy. So stocks today are priced very high. Neither of these measures, whether we look at the Shiller-Cape PE ratio or the U.S. total market capitalization, none of those are good from a short-term, market timing perspective. That's not what we're after by looking at these types of indicators. What we're after is just understanding how much opportunity is in the market on a long-term perspective. And when we see these market valuation indicators priced very high, it doesn't mean that stocks have to start dropping. And in fact, high valuations could go even higher over a short or intermediate term period. But it also does mean that there's a lot of risk, a lot of air underneath the market if something happens to cause a change in the market cycle. So from this perspective, it looks a lot more like 2000 than 2004 or 2010. Obviously, we'll be monitoring the potential change in the long-term momentum indicator, and certainly if it were to progress into a negative status, that would make us a little bit more concerned. Future updates will be making you aware of the change or the progression of this indicator. Well, in our update at the end of 2021, we highlighted this chart that shows a number of various growth asset classes and really how significantly many of these market segments have deteriorated through 2021. Whether we're looking at the initial public offering ETF or the China ETF or the SPAC ETF or the ARK Innovation ETF, we could see during the course of the year from their high, they were off 24 to 39%. Now notice how correlated all of these ETFs are, with them dropping off of their high in February and really starting to have that first wave down early in the year and then a bit of stabilization and then a second wave down toward the end of the year. Well, let's now take a look at so far what's happened in just the first 2 weeks of 2022. And what we see is further deterioration in all of these areas of the market, particularly in that ARK Innovation Fund and the IPO ETF, as well as the SPAC ETF. These areas of the market continue to get hit pretty hard, represent some of the more speculative and higher growth, innovative, disruptive technology type of companies. But on top of their 25 to 40% or so drop off of the high last year, they've added another 10 to 20% in decline so far this year. Now let's look at a few other market indices and how they started off the year. Well, the S&P 500 is down about 2% coming into today. Today, stocks are weak, at least so far. A little bit of time left in trading yet. The NASDAQ is down 5% in the first 2 weeks of the year. So a little bit more, weakness spreading over into that growth part of the market, although that's the large growth companies. But look at that ARK Innovation Fund, down about 15% so far just this year. Meanwhile, we do have rotation and money flows into some other areas of the market, like the financial sector up 5%, the energy sector up 13% in just the first couple of weeks of the year. So, the growth and value segments of the market are very different. Going back almost a year and a half, let's say 15 months or so, the end of 2020, we started to talk about how there may be a potential change in the growth versus value relative, price movements in the market. And while that did play out quite a bit at various times in 2021, where value stocks, the energy sector, for example, I believe was the best performing sector in the market last year. We're seeing that start to continue to develop here in the early days of 2022 so far, and we'll continue to monitor that development because that could be a meaningful shift in market leadership from growth stocks to value stocks. That could have other ramifications as well. Obviously, we'll be continuing to monitor that and report our observations in future updates. So, as we reported towards the end of last year, there are some concerns that we have with the market, the lack of breadth participation, how the market had been really concentrated into really a small number of stocks, the activity that really drove the market indices higher because of the weighting of those big companies. Meanwhile, as we could see here today, the smaller growth companies have gone through really a bear market, and it's coming up on a year since they hit their peak in last February. So we want to continue to be aware of that. Bear markets from a general market perspective are much different than a bear market in just a small or select group of stocks. But usually those smaller and select group of stocks, if they're the highest growth areas of the market and they're deteriorating, it tells me that money is moving away from speculation into more safe, conservative investments. And from an active risk management standpoint, that's not a great sign that investors are less willing to take risk in the higher growth areas of the market. So certainly we want to continue to pay attention to that. We want to continue to pay attention to our long-term momentum indicator and the other indicators that drive market signals. We would like to see that momentum indicator start to regain strength and not slip into a negative trend. If that happens, the chances of a bear market start to increase. We're not there yet, but we'll be continuing to monitor it. And we'll continue to monitor the relative trends of where the areas of the market are shaping up. Will the energy sector, financials, and some others have good years, potentially, while some of the sectors that have run up in price, like the growth areas, underperform? So that's going to wrap up this week's update. Thanks so much for watching.